All right, so now that we're in the financial model, this is where you're going to be dialing in the forecast for your business. Out of the box, it's going to be built out. It's going to incorporate those past 3 years of financial data, including transaction level history, learning seasonality, in order to build this out. However, there's always things about your business that you know better than your past data does. So that's why you want to create assumptions. That's why you want to create new accounts or group accounts together. Because while this reflects all of the data from your QuickBooks or your Xero, there's always more to incorporate moving forward. So the first thing I typically do when I enter into our financial model is I think, okay, is our chart of accounts still accurate? Or is there a new product that I want to model out? Or are there groups that I want to create for more financial visibility? For that, I'll go to these 3 dots here. I'll click either add row or create group. The next thing I'm going to do is I'm going to think, okay, how do I make money and how do I spend money and how are those things changing from how they were in the past? We're ready to build our assumption. We establish a name for it as well as its timeline. So when do we want this forecast to end? We'll select our forecasting rules. This could either be manually editing, which is going to overwrite each individual cell. We can also use a growth rate, which this is either a month over month, quarter over quarter, or year over year growth rate. And then we have a percentage of account. This is really useful for COGS. Let's say our COGS was consistently 25% of revenue and we built out a revenue forecast. Well, we're going to want to keep that relationship between COGS and revenue solidified going forward. So we could do a percentage of account rule. We also have our price times quantity or product service. This is really useful for our direct to consumer models or e-commerce models where you have maybe, let's just say a $15 product and you're planning on selling 100 of it. And then we have our custom formula, which is my favorite. It's super flexible. This allows you to do just about anything in Clockwork. And for this, I'm just going to build out a mock sales pipeline. So I'm going to call this average deal size. I'm going to add another variable. It's going to be multiplied. This is going to be number of leads. I'll just call it leads. And then we have our conversion rate. So essentially what I'm building out here is our entire sales pipeline. It's incorporating conversion, leads, and average deal value. So we have it, really accurate. And then we have, let's say, just like 5,000 is our average deal size. We plan on this staying the same. So I'll click that green arrow. I'll say same value each month. We can go ahead and apply it there. Our leads, we're actually running a new marketing campaign. So we think this is going to go up and this is going to change by about 2 each month for the next 4 months. Then we have our conversion rate. Let's just say this is industry standard, 25%. And this is going to stay flat across the board. I could add more variables, but this is actually going to, encapsulate everything I'm trying to do here. So we'll go ahead and save that rule. And then we'll save our assumption. So that's how you build an assumption in Clockwork. And now we see that this line also has aqua over it, which means it has an assumption. And that assumption we created now impacts our cash flow as well.